Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday, May 8th, and we are not coming to you live today. There's a regular podcast recording, but in the updates we've seen recently, we've certainly seen a lot of more development towards deals when it comes to partnerships and on trade, away from the tariff rhetoric into the deal rhetoric that is cheering markets. We've seen movement on the interest rate front and simmering issues on the geopolitical front, as well as when it comes to the economy. So let's dive in. So in this week's podcast, we're speaking about US exceptionalism. We're seeing more US exceptionalism, not in the way that we would have defined before. But let's dig in a little bit to what that means. Although just as we were producing this, we had yet another example of US exceptionalism in the new Pope being the first Pope to be of American origin. We had white smoke at the Vatican, and that will be the new Pope Leo XIV. So exciting news for the world's Catholics, and at least a swift resolution to what could have been a protracted and somewhat fractious decision process. As usual, we'll cycle through inflation, interest rates, equity markets, geopolitics, and other asset classes. It will be a slightly shorter than usual podcast today, just as I'm about to hop on Bloomberg to discuss the market movements across the week. So I will have to cut this off at about the 10-minute mark, but we will hopefully have enough to cover in that time. So in terms of American exceptionalism, the Fed is standing alone. It has taken the decision not to follow the trend of other central banks around the world in cutting rates. We've spoken before about the European Central Bank cutting rates 7 times, and now the Bank of England cutting its rates for the 4th time out of 7 meetings. That's base rate now at 4.25% in England. That has given markets some cheer, at least in the UK, although it did place sterling a little weaker initially. We've discussed how hard data is goodish, not the soft data. This is a continuation of the theme from last week. We are looking at different challenges on the geopolitical front. That is, again, more of the theme of last week. And then we ask where we go from here. In terms of inflation, it's important to look at the role of energy here. We spoke before about lower energy prices perhaps being the pull that could draw energy down. And what we've seen is that the cheaper oil has not yet flowed through to the pump. So that's a little bit surprising. We would normally, if we look at the chart here, which shows the tracking of the gas price with the WTI crude price, we can see that on average, these do tend to track. We have not seen since Liberation Day those two prices moving in tandem. And suggestion here is that perhaps at the pump prices are being kept artificially high, partially because of inventory front loading, which we did see happen across other consumer goods. But this could also be because inflation is still affecting other parts of the supply chain of gas to the pump. Could be labor, could be equipment, could be simply other parts of the chain that are keeping that price high as a buffer. So not yet seeing that through in the consumer prices after the aftermath of Liberation Day. We can also see that we've seen that the tips have not been moving in line with crude prices, suggesting that the inflation expectations are still high, that the inflation expectations as reflected by the inflation break-evens remain between 2 and 2.5%. They have been as low as 1% in the aftermath of COVID, but we can see that they would normally track WTI crude prices, and they are breaking away. They are not dipping the way crude prices are. So we've spoken about this before, that consumer expectations of inflation remain quite elevated, and this is a suggestion that they perhaps are looking around the corner to the effect of tariffs and concerned about what's likely to be the impact on their spending power. Moving to interest rates now, and last week we knew that the signal was that rates would remain unchanged, and there was no surprise, therefore, at the latest Fed meeting on Wednesday. A little bit more mention of uncertainty and tariffs in the press release, in the press conference after that, but still no surprise that the rates remained unchanged, stable at that press conference and at that meeting. And really, it was simply suggested that this was giving the Fed plenty of ammunition for further cuts should they require that. We also have seen that there's still the same expectation of around 3 rate cuts in the second half of this year. That has not changed, but we can see that at least as of now, we have not yet gone on that cycle. It seems that the US exceptionalism that I spoke about in the title is now manifesting in a breakaway in terms of how the Fed is facing the higher inflation and unemployment than perhaps other developed countries, which is why that they seem more confident, particularly the ECB, in cutting rates. So different divergence there in terms of the central bank action around the world. And we can see equally that the market seems to have been a little bit fed up, perhaps, with that Fed day. They were not particularly paying attention to what the Fed had to say. It seems that this market reaction has been much more accelerated, much more accentuated around tariff news than around the Fed news. And what we can see is that despite the fact that the market still sees 3 cuts this year, they seem somewhat nonplussed by the Fed statement. And it seemed to be a bit more of the same in terms of how they reported on the tariffs, bringing a flood of uncertainty into markets. I spoke already about the Bank of England bank rate coming down, and that has come down to 4.25%. You can see this Table Mountain style image that we've used for some time. The idea that we have rates going up and then a flatlining and then coming down the mountain. And it is, of course, coming down the mountain that is the most perilous at times. We've spoken about that when it comes to coming down the mountain of inflation, but equally coming down the mountain of interest rate cuts. There's a balancing act there in terms of not overly stimulating the economy. I'd say the Bank of England actually in its statement suggests it does see rates coming down further. I think they know that they need to act as much as they can to stimulate the UK economy. So very little surprise there. Just to harken back to last week in terms of a reminder around the soft indicators, we spoke about the hard indicators being somewhat mixed. And last week, we really dug into the US GDP numbers, which were negative and slightly negative on the year, but quite distorted from a trade imbalance, which had been created due to excessive imports, which were really bringing forward some of those purchases into the first part of the year. So the hard indicators have been somewhat distorted. The soft indicators, though, seem to be consistent in generally being softer and more downbeat than we would have seen before. This comes across not just from consumers, but also from small businesses. Moving then to the new narrative around the stock market, with a new narrative we've seen, according to headlines, that we've moved from the tariff setting phase to the deal making stage, and that markets do like the deal making stage. A big announcement was heralded in all caps by the president this week, and that big announcement has turned out to be a trade deal with the UK, which we'll talk about in more detail just in a minute. But clearly that, as well as the fact that Scott Bessent and his Chinese counterparts are meeting in Switzerland this week, is a sign that we are really at the stage of cranking out deals. We don't yet know how easy these deals will be. We don't know what concessions will be achieved and whether we will essentially be back to where we started. But at least for now, the market seems to like this progress. And I think it seems to suggest that the momentum is around rolling back from the tariffs. So we had a 9-day streak of strong performance up to the end of last week that was broken at the beginning of this week. But we have seen again, since the last few days, we have seen the markets take off again, led by the NASDAQ. A lot of that fueled, of course, by the very strong performance on the part of the Mag 7 stocks, which have continued to outperform and overachieve when it comes to their earnings. When it comes to where we are in terms of where we used to be, what we can see is that the US stocks have made up their lost ground versus bonds, in that if we look at the US and the ratio of how the S&P tends to trade in terms of a moving average relative to bonds, it has generally made it back to its moving day, 200-day moving average. What we can see, though, is versus the rest of the world, the US is still continuing to lag. And last week, we spoke about the fact that the rest of the world has generally rallied harder on good news than the US at the moment. There seems to be a sense that the rest of the world has many other fundamental tailwinds because they're not essentially ground zero for some of these tariffs. Although, as the headlines we'll discuss in a minute show, we clearly are still seeing an effect of these tariffs around the rest of the world. I want to touch on a few slides that I glossed over quite quickly last week due to the length of that podcast that was live in St. Louis. A personal savings chart which showed that personal savings remained quite low and certainly back to the lows that they were at in around about 08-09. And we did see a spike in personal savings around COVID, and personal savings still around 4%. All would underscore the stress on the consumer. And home sales have been somewhat flat. We've seen this occur, that basically the existing market for existing homes has been quite flat and sluggish in the US in what is traditionally the hottest spring season. So a little bit upsetting there in terms of the demand for real estate. Back to geopolitics, we've seen this was coming from last week's geopolitics. We had the US and Ukraine, the natural resources deal. We had the bombing campaign against the Houthis, all just a lot of turbulence in regions that have been simmering for some time, but certainly were by no means showing any sign of abatement. But again, this week, another dial had been turned up in geopolitical tensions when it came to India, Pakistan, accusing each other of drone attacks on military targets. This came in the aftermath of the terrorist attack in India. And we can see that this really took a lot of the markets by surprise, particularly the fact that the vice president had just been in India and was securing stronger deals with India. A little bit more of a surprise there. So far, very little impact on markets. But Bitcoin has been rallying as risk assets have returned, and that has suffered a little bit on the side of gold and other kind of more hedging assets. Bitcoin is again back to near $100,000 as trading tensions have eased. And just another reminder, this was an idea that I floated last week around complex systems and their weakening when deprived of stressors. I'd say that we're still seeing a lot of stressors in the system, stressing the system. But as we can see from the recent streak of performance, the system is still holding. So that is a very strong sign. That is it for this week, a shortened podcast on the back of a very long and detailed live podcast last week. I'm about to hop on Bloomberg, so I better go and do that. And thank you everyone for your time.